We have a great panel, so I hope that the next 2 hours will be exciting with an all IMF panel, former Deputy Managing Director, former Chief Economist, and current former Scourge of Argentina, and for selfish reasons, I am renaming this panel as The Growth in Financial Stability. So that's the title of my book, for which you've just got a pamphlet out. But it's with a purpose that what has been very interesting in the last 3 years, apart from the discomfort caused by what I insist on calling North Atlantic financial crisis, not the global financial crisis, just as there was an Asian financial crisis and not a global financial crisis in the 90s. One of the interesting things, of course, of this has been for people like us is that it generated a huge amount of work and rethinking the ways of thinking about the financial sector, particularly because Nick has got good advertisement over there. So what the whole world is now talking about is how to sustain growth along with financial stability. And what has been interesting, of course, is that prior to the crisis, the world in some sense had settled into a large degree of comfort and complacency on the operation of banking, financial markets, and of financial regulation. So there was a reasonably settled sort of view that monetary policy should basically be inflation targeting, financial regulation should basically be light touch regulation, that financial markets were efficient, and that cross-border capital flows ought to be open and free. Now, what the crisis has done is that each of these views is now being questioned. And I don't think one can say that there's a settled view now. It's in great flux. So efficiency of financial markets is in question. And the report that I found most interesting on that is Adair Turner's report of 2009 from as chairman of the UK Financial Services Authority, questioning a lot of the efficiency of financial markets, usefulness of financial innovations, etc. And then the UK FSA, which was in some sense the beacon of light touch regulation, is now consciously moved to what they themselves call intrusive regulation. Then, of course, with all these things that have happened, huge discussion in Basel, in the Financial Stability Board, which now has a new chairman as of yesterday, Mark Carney from the Bank of Canada. And it's kind of indicative because among the developed countries, it was Canada and Australia that have escaped in some sense from any particular damage to their financial sectors. So it's very instructive that the new chairman of the Financial Stability Board is from the Bank of Canada, and the vice chairman is Philippe Hildebrand from Switzerland. And a huge amount of discussion going on in the BCBS, the Basel Committee on Banking Supervision.
Sure, of course.
And of course, the Dodd-Frank legislation, new legislations going on in the UK, in Europe, everywhere. What had not received as much discussion in the last 3 years as financial regulation has had is, in some sense, rethinking of central banking and monetary policy. And here I think the best report I have seen in the last 3 years has been co-authored by Raghu, just come out from Brookings, called what? Rethinking Central Banking. That's the correct title of it, right? Rethinking Central Banking. And I would certainly recommend that to all of you. It's amazingly well written. I wish I could have written my book in the same style, but it's really very clear and very concise. And again, a lot of rethinking there. To a certain extent, moving away from inflation targeting, particularly focusing on financial stability. Also going away somewhat from the early received wisdom of separating monetary policy from financial regulation. But these things are all under discussion, and I really think that it's exciting times. And finally, of course, similarly on cross-border capital flows, some rethinking in the IMF itself on when there ought to be some kind of management of capital flows as opposed to completely free capital flows. So I think that there's a huge amount of thinking going on, and we have about the best panel you can on the subject. So we have Anne Krueger, who you said you'll talk more about global imbalances largely, which again have been behind a lot of the trouble that has gone on. Raghu will talk about rethinking central banking. I think is what you said you'll agree to do from their report. And Anup, sort of on financial markets, bond markets, and so on. So I think we will be covering a good part of the arena that we have. So Anne, can I ask you to go ahead first?
Okay. Yeah, I thought I would start with sort of the interesting question that came up, I think, during the recession, and basically argue that it's a non-question, and of course it does concern global imbalances. And the question that everybody said, well, was it financial or was it real? Is this a financial cause thing or is this a real cause thing? And I think I want to argue that it was both simultaneously, and that you cannot look at it at only one side or only the other. On the real side, there is no question that in some major countries, including certainly the US and the UK, and Spain most visibly, although Australia almost got there and then managed to back off, there was quite clearly a boom in construction and in real estate. It was triggered, of course, by the fact that long-term real interest rates were low or possibly even negative part of the time. And it was certainly, if not caused by that, it was certainly accentuated by that. When real interest rates are low, negative, people are more attracted to longer-term investments where the maturities, where the interest carrying cost is lower, and so on. And when that happened, of course, you got into a position where, in the short run, the demand for real estate went up. People started building more, and of course the situation got overbuilt. And if you think back, the interesting part is that in the United States and in several other countries, the downturn in construction and in housing and real estate prices, commercial real estate as well, preceded the downturn and the big blow up on the financial side. So it is hard to argue, and I don't think you should argue that, well, this was all financial, because it wasn't. It was partly real. Now, there might have been a run-up in housing prices or real estate prices here or in the UK otherwise. It certainly would not have been as pronounced as it was. It almost certainly would have petered out sooner than it was had it not been for the low real interest rates. So that's the real side, and I could spend more time on it, but I don't want to spend very much more except to say that whenever real interest rates are low, there's quite clearly a search on the part of the financial institutions for yield. Because when the real interest rate is very low, they have a very small margin to work with, and they're looking for anything that will pick that up. And that quite clearly intensified things. Credit expanded rapidly, and with that, some of the projects were doubtful, and that also intensified things both on the real side as well as the financial. With their low real interest rates, people will take on crazy projects that they would not have taken on at higher rates, and that clearly contributed too. But what happened that was unusual in the last decade, and it was very unusual, was something that's quite different. In the normal circumstance, a country that has a current account deficit that is larger than makes sense on grounds of how much investment possibilities it has. So I mean, one can think about, so to speak, a capital inflow that's generated simply by productive investment opportunities beyond the difference between saving and investment in a country, and then having a capital inflow because there's still lots of productive things to do around. Or you can think of a country where consumption is greater than it should be, and so basically there's a capital inflow to cover the deficit between savings and investment in a country. And obviously, empirically, it's hard to do this, but conceptually, it's fairly easy. If a small country runs what I'll call an unwarranted current account deficit, because it's excess demand within the country and because of all that, Turkey right now has a 10% of GDP current account deficit, and it is not driven by excess desire for investment. It is basically excess fiscal expenditures and stuff that then lead to a current account deficit that's quite large. In the normal circumstance, when a country runs that kind of deficit, the pressures on that country to adjust emerge. They emerge in the form of the country perhaps borrowing somewhat more than it should from abroad, perhaps then running down its reserves, but at some point, the need to cut back expenditures and to adjust its production so that more goes into tradables and less into non-tradables takes over. A small country all on its own in the world economy has no choice. And this has happened to any number of countries over the years and will continue. It's not a surprising thing. You cannot go spending beyond your income for terribly long before your creditors won't extend you any more credit. And then you do have to do something, and that's the case. Likewise, if you have a small country that's running a current account surplus beyond its need to accumulate assets from abroad on net, what happens, of course, is that there are inflationary pressures. It can try to sterilize, but sterilization has its limits, and as it has its limits, inflationary pressures tend to build up, and those pressures in turn tend to lead the country to make some adjustments of a form that will bring down the inflationary pressures and cut the current account surplus. What happened after 2000 that is so unusual, and why it is more global than just North Atlantic, is that, although I take the point, what happened at that time was you had, on the one hand, the United States, which for a variety of reasons, some of them policy-induced, some just because of history and so on and so forth, starting to spend well beyond its means, and wanting, therefore, with a fiscal deficit and what have you, and consumption rising rapidly and very low private saving, to borrow from abroad. And you had another large country, also growing very rapidly as it happened, with investment rising, but less rapidly than savings. So you had one very large country with a current account deficit, and another one with a very large current account surplus, and I think of them as mutual enablers. Had either country alone, and there are really groups of countries, oil exporters were involved and so on and so forth, but let me make it simple. Had either side been alone, so that one country wanted a deficit but there were no surplus, there would have had to be adjustment, and vice versa. But we had the accident, if it was an accident, of the two sides, each letting the other get on with what it was doing without the adjustment that was necessary. What happened was, therefore, that the real interest rate was very low, especially since the United States market financially is very liquid and very broad. And so basically the mechanism came through the U.S. low real, and sometimes not even positive interest rate, to the financial markets of the world. And with that, we had global imbalances, about which Raghu is perhaps one of the world's experts and may want to correct me or say more. But with that, we had a problem that certainly contributed to the severity, if not led to, the financial crisis and the real downturn of 2007 and thereabouts. Now, lots of things, as always, when something like this happens, lots of things accentuate it in a variety of ways, including, of course, the development of new financial instruments, which is normally a good thing and where they normally may have time to get sorted out, and instead got used, if you like, too much, too fast without doing test runs as it perhaps should have happened. And some other things happened, too, that made the crisis far worse and have, of course, led to the calls and the need and the rethinking that Rakesh talked about for better financial supervision and regulation. We do need to recall that the financial system is horribly important, and we need a well-functioning financial system which intermediates between the savers and the investors, and which can appropriately assess risk-adjusted returns in various alternative activities. And it's important, as we get new regulation or as we get amended regulation, that it be of forms that improve the functioning of the system instead of destroying the system. That could include whatever happens on capital controls and some of the other issues that Rakesh was discussing. But there certainly can be ways in which we can try to see that the same mistakes won't necessarily happen again. In the absence of some other measures, however, that would not address global imbalances should they recur. And quite clearly at the moment, and I'll come to that in a minute, there are some more short-term hurdles. But at the moment, it is hard to see what would prevent a buildup, once again, of Chinese current account surpluses and U.S. current account deficits. The U.S. has not adjusted yet as it should, and the Chinese certainly are once again building up their current account balance as you might expect they would. So one of the longer-term threats to the international financial system, which I think is very real, is that you might see, not next year necessarily, or not even necessarily in 3 or 4 years, but you could see a repeat of the same kind of thing again. And I think that that is not under discussion very much now. Interestingly enough, the G20 tried to address the issue in their first meeting, where they talked about having a mutual assessment process. That was after Raghu and others at the IMF had tried very hard to have multilateral consultations, which would have done the same thing had it worked. In both sets of activities, the multilateral consultations, and then later the mutual assessment process. The whole idea was that everybody agreed that you shouldn't have large imbalances, and that what should happen was that the surplus countries should cut down their surplus and the deficit countries should cut down their deficits. And the idea was that everybody would meet and they would agree on this, and then there'd be a plan so that each country would go home with its allocated task in terms of what it would do. What in fact happened was that they did meet, they did agree on what the total adjustment should be, and they disagreed after that because obviously the deficit country thought that the surplus country should do the adjusting, and the surplus country thought that the deficit country should do the adjusting. So that everybody agreed on everything but the one thing that was important, and the one thing that was important is the one thing they couldn't do. So in a sense, in the longer term, I would argue that for both financial stability and for growth, addressing that issue probably through a multilateral institution is important. And the real trouble is that as of now, there is no mechanism and no plan for a mechanism and no discussion of a mechanism that might possibly bring the world to a point where the international financial institutions or somebody else, Financial Stability Board or someone, could possibly address the question of unsustainable balances. And yet it's a real one in the longer term, and one that it seems to me needs attention now before things build again over the longer term. The mutual assessment process, as far as I know, has had the G20 each submitting their macro plans to the IMF, but from what I've been told, and I've read it in the newspapers rather than from anybody in the IMF, and those plans have been looked at and nothing has happened. It's a mechanical exercise, and nobody has changed their plans on that account. So that is still there. And it's a real question mark over the longer term. It's even more of a question mark over the longer term, of course, because the current crisis led countries to generate large fiscal imbalances, which in turn led to large increases in sovereign debt in a number of countries. And those increases have led to much higher than previously accepted debt to GDP, sovereign debt to GDP ratios, which in turn are an issue because coming forward, most of the industrial countries and a few other countries, including China and Korea, are facing a very abrupt and very near-term turnaround in their demographics, such that the fiscal deficit is bound to be difficult on that account, as there has to be adjustment to account for the payments for health and social insurance for the elderly in many countries. So going forward in the medium term, we face problems on the fiscal side, and how that feeds, and how those are financed feeds into financial stability. And we face problems on the global imbalances and what they do, even if we didn't have the demographic problems, which do imply rather substantial shifts in the current fiscal balances of many countries. So that's where I would argue the longer term, I'll come to what implications for India in a moment, where the longer term issues are. But before people could even get to addressing those issues, of course, we have the current euro crisis. And the current euro crisis throws everything into question until something happens on that, because obviously if depending on what decisions are taken and how they are taken, there could be major implications for financial stability throughout the world and therefore for the growth. What's interesting is that so far, the decision makers seem to be getting further and further behind their target. Every time they meet, they do something, but the gap between what they do and what's needed seems to be growing rather than decreasing. And I haven't heard the news today, so I don't know what the latest twist is, but there's bound to be one. And I fear, in a way, that the real problem for growth and financial stability is that focus is going to be so much on the short-term, very serious European issues, that the longer-term issues for financial stability will be neglected. But let me finish by saying that if somehow global imbalances are more or less addressed or avoided, and they could be avoided by chance, and if somehow the European situation goes through, then the prospect is that most of the industrial countries will nonetheless have to adjust seriously as their labor force falls as a proportion of their total population, their dependency ratio rises, and therefore their pension and their health care costs rise as a percentage of the total GDP, and so on. As that happens, one would expect in the normal course of events that real wages will rise in the industrial countries, and the real return on capital will presumably fall because you've got more capital per man, and so on. With that, I would argue that a country like India, and I'll leave it to the experts at a later panel, Rakesh has wanted to talk about this, but that if the prospect is for relatively lower real interest rates in developed countries over time, that argues all the more strenuously for countries such as India, if there is any other country like India, for countries such as India to be adapting and opening carefully their financial system to be able to incorporate those flows, because it creates a tremendous opportunity in terms of an ability for India and other countries which have a large supply of relatively unskilled labor to expand rapidly or fairly rapidly in those activities in ways that could accelerate growth and be very growth enhancing. There are risks, of course, that the financial system will have difficulties before that. We won't ever get there. There are risks that the industrial countries will not adjust, but on the optimistic scenario, and we have to keep it open, then I think the longer term with financial stability reinforced by some of the measures that Rakesh mentioned, and I'm sure Raghu will go on, then the opportunity for India, I think, is to get more flexibility in India's own financial system with appropriate regulation, such that advantage can be taken of this new environment in which capital is more abundant in the industrial countries, and there are more opportunities in India. I'll stop there.
Thank you, Anne. Just one question ask Raghu, that actually your rendition of the imbalance between US and China is also very evocative of within Europe, that it was the peripheral countries which were running all the deficits within Europe, and the core countries, particularly Germany, being China, and sort of Portugal, Spain, Italy, Greece, all running in terms of very large deficits of similar orders of magnitude, like 5 to 10% of GDP. And what is sort of interesting is that one of the problems there is that they don't have the exchange rate flexibility, which could be used to at least reduce, if not solve, the global financial imbalances. Raghu?
Sure. Let me just, first, a couple of points on what Anne said, which, I mean, endorsing everything she said, but this whole issue of how is it possible to get big countries to change policies, I think is a very important one. And I don't think...
Shut this so that...
Actually, I need it.
Oh, you need it. Oh, yeah. I see. Okay. But, I thought it was coming in the way.
I mean, there is this very, very big issue of, you know, whether the multilateral financial institutions will ever have the clout to force change in big country policies. And I think at least over the next decade, it's hard to see that happening. Part of what the reason, in some sense, why it's so difficult, and certainly Anne and I, when we were working on the multilateral consultations and getting countries to actually speak about what they will do, I mean, clearly it's very easy for countries to point to other countries and say, the reforms that you need are in your long-term interest, why don't you do it now? Well, the reason they're not doing it is the reason you're not doing reforms now, because reforms, even if they're in long-term interest, have short-term political costs. And therefore, you know, they're sort of on your wish list, and you keep saying you will do it, but of course, you're waiting for everybody else to move. And it seems to me that every time we have these major gatherings of world leaders to try and address this issue, we get this anodyne statement at the end of it that everybody will do their bit to address it, but of course, what this means is there's no progress. And I sort of am at the point, and maybe this is where Anup was before this whole exercise started, that getting people to come together to promise to do things is just very difficult, because they simply don't have the political capacity to promise these things at these big meetings. Over time, maybe they will reform domestically. It's a whole process. But President Obama has no capacity to say the US fiscal will come down. President Hu Jintao has no ability to say that they will even appreciate the renminbi, let alone how much and by when. These are all political decisions that are taken through consultation that it's very hard to commit to. And that, I think, is the basic problem here, that the spillover effects of a country's policies are huge, as Anne pointed out. They have damaging consequences, but the policies themselves are determined with domestic interests in mind, rarely with these spillover effects in mind. And as a result, we get suboptimal policies for the world, but it's just hard at this point to think of how we will change that other than through a global effort to try and educate the thinking public to try and internalize some of these effects. At any rate, that is a sort of good preamble to a description of this report that Rakesh was so kind, described so kindly. First, I have to say, whatever good writing here is in this is Barry Eichengreen, not me. This is a report by 16 of us. Actually, Barry and I thought that there might be some value, given the problems that Anne talked about, to getting a bunch of people outside the political establishment, outside the multilateral organizations, to come and think freely and talk about what needs to be done. And we didn't want to touch global imbalances because it's sort of clear what may need to be done. It's just doing it. But we thought that talking about central banking might be a good issue to start with. And so a whole bunch of luminaries agreed to be on this. Ken Rogoff, Mohammed El-Erian, Arminio Fraga, people like that. And I think at the end of it, somehow we got consensus. Now, I have to say, getting 16 people to agree to anything meaningful, I mean, yes, they can agree to really boring documents which don't say anything. But if you're trying to say a little something, we had massive fights, and I have to say that at the end of it, we could manage to pull out something. Now, what I want to do is just describe the document, then talk a little bit about regulation for 1 second. So we started this, the report is Rethinking Central Banking. We started with the prior consensus, which Rakesh pointed out, that had emerged in the world and which got strengthened during a period of relatively low inflation in the early 2000s. And the view was there's no permanent trade-off between inflation and unemployment, and I think most economists would still subscribe to this idea, that the whole notion of injecting a certain amount of inflation on a regular basis and bringing down unemployment, a la Phillips curve, is unlikely. Also the consensus that high and volatile inflation hurts growth. And this pain is also most felt by the poor. Taking all these into account, we got the rationale for inflation targeting, which was basically focused on trying to keep inflation within a certain band or at target, and in the process minimize output gaps. So there's no sort of trade-off seen here between inflation and growth. By targeting inflation, you achieved growth in an optimal, the necessary growth in an optimal way. And of course, concomitant with this was flexible exchange rates that allow exchange rates to move as they go. Intervention is unnecessary because the whole process of movement helps you smooth out demand shocks. And the sense was if all countries did this, you had a wonderful equilibrium for the world. It was so long as countries keep their own house in order, if there are demand shocks, the exchange rates will adjust and thereby allow countries to grow in an optimal way with macroeconomic stability. And one sort of collateral element of all this was the so-called Tinbergen principle, that one objective needs one instrument. Use interest rates to tackle aggregate demand. So monetary policy, the major monetary policy tool, interest rates, should be used to tackle aggregate demand, and use supervisory measures to tackle financial stability. So we had everything sewn up. Inflation targeting, monetary policy is primarily about demand, exchange rates allowed to fluctuate, and financial stability is taken care of by supervision. But this kind of consensus has broken down over the last few years. One major reason is that we've seen financial sector risk built up even while inflation remained low. right? Throughout the 2000s, across industrial countries, inflation has been relatively low. But we've had asset price bubbles, at least two in the United States, now a third possibly in farmland. The two were the internet bubble and then the house price bubble. And there was a sense that if you did what was prescribed by the central banks, the sort of called Greenspan or Bernanke doctrine, which is we can't identify asset price bubbles while they're building, but we can certainly pick up the pieces after they've burst. Well, that created an asymmetric structure, right? Because you clearly could recognize them after they had burst, but you couldn't recognize them while they were building, which meant you intervened in a massive way in the downturn, but didn't lean against the wind in the upswing, which then meant that policy was asymmetric. Another way of saying this more colloquially was this was the Greenspan put, that the stock markets were essentially, and asset markets more generally, given the assurance if things turned really bad, the Fed would come to the rescue. And you can see that actually in Fed policy even today, and we'll talk a little bit about that if I get time. So that was one problem. The second problem, which is what Anne pointed to, was that it wasn't that every country was a floater. There were floaters and fixers. And the fixers, in a sense, made it harder for the floaters to do what they wanted to do. For example, as Rakesh, pointed out to me very clearly, in the period of monetary expansion in the West, because of capital flows, a number of Asian economies pushing back the capital by trying to, contain the growth, the rise in the exchange rates, and so you've got this, conflict in a sense of monetary policies. One policy pushing capital this way, the other policy pushing capital that way, and the net effect is the kind of financial sector imbalances that we saw in 2005, 6, 7. Nowadays, there's also spillovers, not just through cross-border capital flows, but also potentially through commodity prices. Of course, economists resist the notion that somehow these capital flows or these financial flows get into commodity prices. But certainly there is some sense that when monetary policy is relatively accommodative, it does seem to have an effect on commodity prices. In fact, the Economist a few years ago had a splendid article. I think, I forget the name of she was the editor, the economics editor, but it was a great article which said because central banks are no longer regulating economic growth through interest rates, they're sort of happy to stay on hold. It's basically commodity prices which are doing the regulation, and you can see that every so often with oil prices going up and slowing growth when growth starts picking up. And finally, there are the effects of unconventional monetary policies at zero bound. You aren't able to spur demand in your country because the normal channels through which monetary policy works, more lending, are basically frozen. More lending and more borrowing. The borrowers can't borrow because they're over-levered, and the lenders, for one reason or the other, don't want to lend. Those channels are not working, which means what happens when you have these unconventional monetary policies is that the effects tend to leak out into asset markets, leak out into global liquidity, and that creates problems for other countries, as we've seen. So given all this, there's been a lot of concern about rethinking central banking, and this has come at a time when there's tremendous pressure on central banks, stemming from the high debt loads and low growth in industrial countries, tremendous pressure on the Fed to do something, even though, in my view, it's pretty much shot all its bullets. It's being asked to pull a rabbit out of the hat every time it meets. QE, Operation Twist. We're going to get fancier and fancier names. But if you see the effects of these things, and I will point to a chart. In fact, this is a good time to point to a chart. This is a chart of QE2, just to give you an example of what's going on. So, what's this? So this is, these are US long-term interest rates. The higher you go, the longer the interest rate. This is a 30-year rate. This is when Ben Bernanke announces QE2. What's happening before then? You have the summer malaise in 2010. The economy is not doing that well. Jobs seem like they're slowing down, so interest rates are coming down. These are nominal interest rates. Ben Bernanke announces interest rates go down even further. So the Fed says, aha, our policy is working. Well, it's continuing a fall which was happening earlier. So another way of seeing this is it was just continuing what was happening. The Fed starts intervening and buying long-term securities, long-term bonds, issuing reserves. Okay, that is QE2, expanding the Fed balance sheet. That starts happening here. What do you see happen as QE2 happens? Well, the theory the Fed had was this should push down long-term interest rates because you're buying long-term securities by issuing reserves. That should push down long-term interest rates. The fact is, it starts going up, okay? And then it stabilizes. And then the Fed stops buying long-term securities. That is the end of QE2. You would imagine that interest rates should pop up. Instead, they start coming down. And this is Operation Twist. The Fed announces Operation Twist, which is they're going to sell short-term securities and buy long-term securities. Again, the idea is bring long-term interest rates down. What do you see happen to long-term interest rates? They go up. Now, I am sure there are Fed economists who will explain this in some way. I can't understand how they can suggest this is something to do with the policies they intended. Unless you believe that every time the Fed announces these actions, it has a miraculous, near immediate effect on real activity so that interest rates move in those directions, or that the Fed had its instantaneous effects on inflationary expectations. You could also argue that real interest rates are relatively constant. It's all inflationary expectations. But otherwise, it's hard for me to explain these effects. And so I'm puzzled to find so much consensus now building behind QE3. There are a bunch of Fed governors who want QE3. I don't know why, because QE1, I think you could argue had some effect. What these QEs are doing, and there's a very nice document put out by BlackRock, which suggests that what they are doing is pumping liquidity into the markets and having an effect on asset prices in the opposite direction to the effect on interest rates. In other words, stock prices are going up, commodity prices are going up when this liquidity is getting pumped into the market. But that's not what the Fed intends. What the Fed intends is real activity because it wants to bring more jobs, which means more investment. But it's hard for me to see a situation where investment is propelled by higher nominal real interest rates, long-term interest rates. So I don't understand that.
Higher or lower?
Higher. So as they pump more stuff into the market, interest rates go up. Okay. Now, I think there could be two entirely separate things going on. The Fed does what it does, and the real economy is doing something else. So as Ben Bernanke announces QE, all the indicators are turning up because it was a temporary, malaise in the economy. Things are getting better. So as things strengthen, of course, real interest rates start going up, nominal interest rates going up, inflationary expectations going up, everything's going up. And then towards the summer, the economy starts tanking again for a variety of reasons. Everything starts going down. This is when the Fed stops. In other words, we are close to Milton Friedman's point that the Fed intervenes at all the wrong times, right? That's another explanation, but it's again saying the Fed is not doing what is needed. My sense is at zero interest rates, it has very little capacity to move things. It has a lot of capacity to do harm, but the Fed can't go out and say, we can't really do anything. Okay, so that, what should be done? Let me quickly walk through our proposal. I mean, when you're talking about central banks, you have to be somewhat conservative, and I think there's good reason to be. What we would like to see is financial stability made an explicit goal, and we were pleasantly surprised to see Ben Bernanke endorsed that idea a few weeks ago. But we would go a little further than he went to argue that interest rate policy is also a legitimate tool to ensure financial stability. Sometimes you want to undershoot the inflation target in the interest of financial stability. Now, immediately people say, well, are you hunting bubbles? Do you have any ability to say when a bubble is building? And clearly not. Sometimes, asset prices grow because productivity is strong. Sometimes they grow because it's irrational. But what we would argue is when you see asset prices booming, along with booming credit, you have to ask the question, would a reversal in credit conditions create serious havoc? If the answer is yes, and I think that answer can be answered more easily than whether it's an asset price bubble. If your answer is yes, then it would suggest some leaning against the wind is useful. You don't stop it dead, but you lean against the wind. And macroprudential measures we think are reasonable. We don't know how they work. We don't know how they work, how much effect they will have, and therefore some flexibility, preserving some flexibility on how much we demand of each of these things is important. And by macroprudential measures, we're talking about things like basically capital requirements, but also countercyclical capital requirements, liquidity requirements. There's a lot of discussion about what the right level is. We don't know. We need to put them into place and work them out. We would argue that there is also a case for capital controls for macroprudential reasons rather than to affect the level of the exchange rate. If you have a lot of short-term liabilities building up in the banking system, you want to move them towards the longer term, and capital, I wouldn't say controls, but measures that push towards the longer term, perhaps the most effective aspect of capital measures, I think those might be reasonable at that point. Finally, I think we would argue that given that these trade-offs between whether we use supervisory tools or interest rate tools are going to be determined by the central bank, makes sense for the central bank to be responsible for financial stability and not to place that responsibility in some other organization. The second, and I'm just talking about the important recommendation. Second important recommendation is we want to get countries to internalize the consequence of their monetary policy stance. And this is why we say, we need a committee. Now, you might say we have too many international committees, but we need one more committee. One more committee where the systemically important central banks report to the G20 on the consequences of their collective stance. So if the US is pumping out money while China is pumping it back, they recognize that. And they say, this is what the effects are for the global economy. What is this going to do? Is it going to change policy overnight? No. But I think it will force them to recognize incompatibilities and to admit it to a body, whether it's the G20 or the IMFC, that can be debated, but report to a body which is legitimate and represents world interests. And hopefully, as they talk about this gets enshrined more and more in a mandate for the central banks on the external consequences of their policies. For the large central banks, this might eventually be important. Is this going to happen today? No. No chance that the Federal Reserve will ever accept that whatever it does has external consequences. And the Federal Reserve basically says, you've got your exchange rate, just use it to avoid the consequences of our monetary policy. Easier said than done, doesn't happen, and eventually comes back to hurt the US through higher commodity prices, etc. But that's the way it is. And finally, we would argue that we don't advocate strong exchange rate intervention, but we want to recognize that when many countries intervene, it could signify serious incompatibilities, and that's a good time to look at macro policy stances. So,
thank you.
Given that, let me stop. And
thank you very much, Raghu. You will perhaps
I should say one last thing I forgot to say. The RBI follows many of these precepts, and therefore
he just said what I was going to say, that the document doesn't mention Reserve Bank of India. I think just once it has mentioned, certainly no references. But what should be done slide? One, look at financial stability. Two, lean against the wind. Three, macroprudential measures. Four, use capital controls somewhat, not in a strong fashion. And fifth, unified responsibility. I thought it described the Reserve Bank of India. But anyway, that's why I like his report. Anup.
All right. All right, folks. Well, these are much more interesting issues than what I'm going to talk about.
if I can find where my presentation is. It's somewhere around here. I might need some help to find it.
Oh, there it is. You're way up on the right hand.
Oh, is that mine? Oh,
You're in the right hand corner.
isolated. No, that's not me. That's my last one. All right. So maybe I should talk about global imbalances instead. But I'm sure somebody will come up and find it for me.
You could just put up Ratan Tata's picture.
Ratan Tata's picture's up, and I'm going to wait for someone to come up here. No,
SCID. Try the SCID. Try the SCID folder on top. Top left.
Okay, that's probably it. No, I don't see that either. My music, my documents. All right.
Documents.
Well, folks, while we wait for my presentation to come up, I'm sure somebody's going to come and help me find it. I'm going to speak a bit about financial stability and how to ensure we have financial stability while we're working on infrastructure. And we saw earlier how important that is for what we're trying to do. I was going to talk a bit more about about global imbalances, because there is some, maybe I'll come back to this later on, some of us now believe that China is doing more than we thought it was going to, but we'll come back to that. I'm going to talk a bit about how to build a corporate bond market. And you may wonder why I'm going to talk about that, but it's important. We need to build up infrastructure. I'm going to talk really what have other countries done, especially emerging markets, especially those in Asia, and coming back to what India needs to do. So while I quote Raghu in my, if you see it, quotation. So why do we have to look at the issue of building a corporate bond market? Well, let's look at infrastructure. Where India has been so far, infrastructure investment has been low. It's been principally and easily met by the budget and from banks. But if you look now at the 12th plan, and if you believe it, it's going to raise infrastructure investment to almost 3 times where it's been, to 9% of GDP, and much of it would have to come from new financing sources, including the private sector. And that's what I'm going to talk about. Now, on the one hand, you can argue India's corporate bond market has been growing. If you look back, we see that issuance has picked up gradually, and even turnover, while being volatile, has picked up. So maybe it is growing. But the reality is it remains very small by all international markets. If you look just at where India is, it's basically around 5% of GDP. That's the size of India's corporate bond market. It's about half of what China has achieved, and much less than what we see in Malaysia and Korea. And what is remarkable, as we know very well, is that this is despite the fact that India has sizable domestic savings. They may be absorbed by the government, but the reality is India does have high domestic savings. So what do we learn from other countries that might be interesting for India as we look ahead? Okay, now what we learn from others is that really a concerted effort is needed to build a corporate bond market. A number of factors. You need various infrastructure measures. I'll come back to that in due course. But essentially, turnover needs to increase. Liquidity needs to increase. These will allow price discovery, which is needed for a bond market to develop. You may argue that India already has a domestic investor base. It can be done. The reality is, as we look at what other countries have done, we need an active and liquid government bond market, in most cases, as a necessary condition for developing a corporate bond market. And as we see at what other countries have done, we see, for right or wrong, they have given importance to increasing the participation of foreign investors in government bond markets. and you've seen building up a new asset class of local currency bond markets in emerging markets. So let's look a bit at this. Let's look now at the domestic investor base. On the one hand, you could argue India is not doing badly. It accounts for about 20% of GDP in assets. If you look at mutual funds and pension funds, it is growing. Again, it is much less than other countries such as Malaysia and Brazil. And also you may argue, if you broaden the investor base, allow the insurance sector to become a major player, that might help. At the moment, like others, it invests mostly in government bonds. There are also issues in the investor base India has. There's an incentive to buy and hold that does not help develop a bond market. What we see also, and what this chart tells us, is that greater turnover in government bonds is what allows better pricing benchmarks for corporate bonds. That is a reality. And then we've looked at what the evidence tells us, and that is trading in government bonds. We find it is generally positively correlated with trading in corporate bonds. What all this is trying to tell us is that development of a government bond market generally has preceded the corporate bond market. We see also the extent to which the emerging market, as I mentioned, local currency, mainly government debt market, has emerged as a new asset class. And this has happened, for good or for bad, because other countries have allowed increasing foreign participation in government bonds, arguing that it is building a virtuous cycle of greater turnover and liquidity, both of which are needed. We certainly see this in East Asia. If you see this chart, you see the extent to which foreign participation has increased in East Asia quite steadily, except for during the crisis 2-3 years ago. We also see the evidence that the increase in foreign participation seems to be associated with higher turnover in emerging market countries. So we see the foreign participation has had positive correlation, is both up as well as down, because you find it can work in both ways. So the issue then arises, what is this foreign participation in government bonds, what does this do to bond yield volatility? Because there are risks, of course, clear risks of capital flow reversals, increased interest rate volatility. We saw capital outflows took place in the last 3 years. But if you look at this in a broader perspective, we've tried to find some evidence of the link between foreign participation in government bonds and bond yield volatility. And as of now, our evidence tells us there is no very systematic relationship between average foreign participation in government bonds and bond yield volatility. Certainly there are clear risks. A lot depends on broader macro issues, fiscal discipline. But also, once you develop an emerging market's new asset class, this may also help prevent the effect of capital outflows on yield volatility. So that's where I am, and the issue is, what has India done? Well, India seems to have done quite a lot. They've allowed investment in the corporate bond market. Much of it, however, has remained underutilized so far. And I believe in the last 24 hours, India has announced a greater, higher limit. So they have allowed certain other things too, tax exemptions, clearinghouses, and so India has done something in this area. We know that India has done very well in its equity markets, so we should be positive. Certainly India's equity markets are very large relative to other emerging markets, and certainly foreign participation seems to have been a factor in that. You may argue that bank lending has room to grow, and this could finance infrastructure. We know that's not normally the case because of the currency mismatches that develop. So in a way, it comes back to the corporate bond market. What does India need to do to develop it? The question I pose is, how important is foreign participation? This is an important issue that we need to decide. Has it really affected turnover? Has it really increased the volatility, the turnover in other countries? There are also other things that can be done which are much easier to decide. One could liberalize restrictions on portfolio choices of long-term investors, obviously insurance companies. We can reduce transaction costs and so on. But in the end, all these measures that India needs to take involve important policy trade-offs. Concerns, as I mentioned, of volatile capital flows. If you open the choices to insurance companies, you've got to look and see, does this protect insurance policyholders? And how to deal with the fiscal implications of reducing stamp duties and withholding taxes. So it is a complicated area. But my last point is, perhaps most important for India, fiscal consolidation is very important. We still have, as we all know in this room, in India, government deficits that absorb a significant part of domestic savings financed by a captive demand of domestic institutional investors. So that's where I am.
Thank you. Thank you, Anup. Thank you very much, Anup, for arguing for measures that would promote financial instability in India. So I really think that we've had a really exciting menu of interventions from Anne, Raghu, and Anup. Lots of things to discuss. So NK, you already have your flag on.
So two small comments to Raghu. First, Raghu, I think that considering the enormous tribute which you have just paid to the Reserve Bank, and delighted to hear that you endorse many of the things that the Reserve Bank is doing. I think that the broader issue that, would you believe that the fact that there has been significant slippages in the path of fiscal consolidation for circumstances which I now regard as purely exogenous, because I could have well understood the fiscal stimulus at the time when you wanted to mitigate the impact of the global financial crisis. But the fact that subsequent action in terms of adhering to any path of fiscal rectitude throws therefore disproportionate burden of adjustment on monetary policy. And that therefore, how do you see the monetary policy span out if it is not supported by enabling policy of adhering to a pre-announced path of fiscal consolidation? So this is one area on which I thought that I'd seek your comments. The other thing, of course, is that when you did plead for perhaps the constitution of another committee, would it really not be more logical that the reform, as part of the reform, the global financial architecture, which began with the International Monetary Fund, we complete that process of the global financial reforms, and then really, although the Financial Stability Forum is a separate entity, we really begin to re-empower multilateral institutions who are best equipped to perform that function. And wouldn't you really think that a revamped International Monetary Fund to perform this kind of a coordinative function would invest multilateral institution with the sort of clout which you'd like it to see? To Anne, of course, just want to ask that, you gave a rather candid assessment of where we are. And it is a bit worrying that with every successive round of G20 consultations, the basic issues of the structural imbalances seem to be getting pushed more and more and relegated into the background. And that really embeds the future recovery process with a kind of uncertainty. because those issues, sooner or later, as you rightly point out, may come to haunt to us. And how doesn't really look forward on some kind of a thing of that being put back on the agenda of global international concern.
NK, just one point I wanted your thought, which is connected with your first question, the fiscal deficit. That now with the various social commitments that the government is undertaking, Food Security Act, Right to Education, NREGA, etc., are we now in a structural mode of high fiscal deficits for a long time?
Well, that's my
that
worry,
affects this issue.
And that is my worry, and that's why I did say that from the viewpoint of of a central banker, I mean, surely, of course, inflation management is his principal obligation, because the charter of the Reserve Bank is pretty much clear and focuses on orderly inflationary behavior and anchoring inflationary expectations, but with a kind of a policy where on the fiscal side, we seem to be going from bad to worse. I don't see how inflationary expectations can be reasonably anchored, and a disproportionate burden, therefore, coming on monetary policy, which will, of course, hurt investment sentiment very dearly. So I agree with you, Rakesh, that now that we are pretty far committed to a whole range of programs, there's more on the anvil to come, because clearly the full implications of what the ambit of the food security bill is going to be has not been spelled out. There's a huge underfunding of public outlays in many areas, which we have today discussed it in terms of the fact that the education one is substantially underfunded. There are other substantial underfunding on that. And on growth, I think that the assumptions which underlie in the budget, Raghu, which really has growth targets fixed with inflation being around 4 to 5%, which is not likely to be realized, then clearly, of course, you have serious problems in relation to tax buoyancy and so on. So I would like to comment on some of these kinds of concerns.
And for Anup, in the same context, actually, that given this fiscal scenario, advocating opening sovereign borrowing from abroad at this time for the IMF is irresponsible. That's exactly what Greece did. That's why they have 80% of their debt is foreign held. So is it that IMF is looking for India to come to it at some point later?
Let me be clear, I'm not in any way proposing that should be what should be done now. That's just what I'm going through. But I will say, however, is if you look at the opening of India, there's one comment I'll make. It's very important to shift the interest away from just having investors involved in portfolio choices and get them into actual, what you call real money investors, into sectors that will help India's medium-term growth. So I think that is the challenge we face. And the issue is not that we need to open up, but the issue is if you take the infrastructure investment of 9% of GDP, it's an important question, how are you going to do it?
Raghu, do you want to comment now?
Yeah. I mean, I'm happy to.
Yeah.
I mean, of course, the fiscal is a huge problem, and the expanded liabilities, we run the risk of putting inclusion before growth, and clearly we need both. And if all the burden falls on the RBI to bring inflation under control, I mean, there's only so much you can keep saying core inflation. Because after all, the public looks at overall inflation, and if you've got food prices galloping because of commitments that are made, it is going to be very difficult. So I think there's no question in India that fiscal consolidation has to be a concomitant of bringing inflation under control. Now, there's also a possibility of working much harder on the supply side. But of course, that requires far more energy in tackling those issues than we have shown so far. And I think that's a big issue that we have, food supply, food distribution, that's something. I mean, it almost seems to me that we're doing the reverse of starve the beast in India. If you remember, starve the beast was, in the US, was in a sense basically ensuring that expenditures would have to be cut back tremendously by, in a sense, cutting taxes and saying that therefore you would have to cut back. Here we're sort of expanding spending and saying, you know, God will provide somehow for the spending that we need. I do have a question to Rakesh, your question to Anup, which was, you know, are you arguing that by opening up the bond markets to the outside, you will somehow facilitate that spending?
Yes.
And okay.
Yes.
Okay, that's,
Yes.
so you,
Yeah, just to, the argument in some sense is that if you have, that it'll be a different argument if we had continued in the mode that we were in the curve, the last slide that Anup had, when the fiscal deficit was coming down till 2007-8. Now, two things there are two implications of what's happening now. One, that with this kind of fiscal expansion, you perforce taking more domestic savings into the government. And so you have much less left for the corporate bond market or savings to fund the private sector. Two, when you open the particular sovereign bond market, you have, with the kind of high inflation that we have, there's incredible arbitrage you're giving with the zero interest rate here and 9% or thereabouts 10-year bond is about 8.8% now available. So you're promoting capital flow because that is seen as a relatively risk-free investment. And so you'll have large flows. And so the exchange rate won't depreciate with the inflation. So you actually have tremendous real exchange appreciation and all that. So we know this cycle very well. And I think it's in your report somewhere, it's also talking about financial, that you need to do some financial repression given the kind of fiscal situation there is.
we don't endorse that, sorry. We're saying it happens, we're not endorsing that.
It's a financial stability issue. That's not something you want to do, but you have to do it for financial stability. And that's really the question. That's the sort of trade-off, given that you have a fisc that is not in control. It's a really different story for the fisc under control. And
yeah. Something doesn't add up here, and I don't know the numbers well enough, so this is kind of half a question and half a statement. 9% infrastructure, plus 5 to 6 or 7% fiscal deficit. Plus
no, that's only central government.
Okay.
If you have the state, it's about
All right,
9%.
right. Okay, then 9 plus
Yeah.
9. Now, on top of that, you've got interest on the government debt. If you're going to lean on monetary policy to control it, because fiscal policy won't, the interest rate goes up, how long does it take before you've got fiscal dominance anyway?
Yeah, exactly.
It seems to me that with the numbers I've been hearing from you, that at the moment, inflation is almost the best of the possible outcomes if I take all of these others as given, because the alternative is even worse, and it's more inflation later.
Yeah, Nadir.
And there's one over here too.
This question is for Raghu. You mentioned that quantitative easing causes asset prices to go up and commodity prices to go up, and therefore this leaks inflation into the global economy. In countries like India, Vietnam, and China, where our inflation is very dependent on commodity prices, what effect does that have in inflation in these countries? And what could be the possible response? The Fed seems to suggest that we should be strengthening our currencies as a response to their quantitative easing, and you said that that was problematic as well. So how do these countries respond to Fed-caused commodity inflation?
Well, first I want to back off a little bit from saying that we know that there is that causal link between quantitative easing and the commodity prices. What we do know is that there seems to be a correlation. When the Fed starts doing these things, those other asset markets seem to be booming. And I haven't seen a rigorous academic study showing, but the chart that people put up shows it.
John Taylor mentions this all the time.
The markets certainly believe it.
Right. The markets also believe it. Now, it may be that we've had coincidence of events that the Fed has started doing these things when the world economy has strengthened, and therefore, you see the effect on asset prices, but it's not really the Fed, it's the world economy strengthening. But that said, I think at least one channel could be financial flows into other countries, into commodity markets, as low interest rates plus liquidity builds up here. And you can certainly see that in bank lending, that banks are borrowing here and lending elsewhere in the world, And that's one channel through which this US policy is being transmitted, not into US domestic lending, but into foreign lending. So how do you react to it? I mean, this is the age-old problem that the RBI combated when Rakesh was there. Lots of capital inflows.
That's why I have gray hair now.
And that's why he has gray hair. And I think the answer across the board seems to be muddled through. That you can't intervene in a constant big way because eventually you run out of ammunition to intervene. The RBI built up huge reserves, but that creates its own problems. And you can't let it go because at some point you fear the reversal, that your exchange rate has strengthened too much, it overshoots to some extent, and you fear what happens on the way down. Now, I think easier is the kind of regime that we've had over the post-crisis, when you haven't had a huge amount of capital inflow, so you've been able to allow the exchange rate to do what it does. But if we had the kind of capital inflows we had during Rakesh's time, it would become much harder to manage.
We were saved by the crisis. If that kind of capital flow had continued, we would not have been able to cope the way we did till 2008. We were really coming to the limit. Ron, I think you were talking the same topic, perhaps.
I'd like to come back to something Rajan said. Peculiar behavior of long-term interest rates in the U.S. at the end of QE2. When you cease pumping base money into the system, you might expect long rates to rise, but in fact they slumped. And one reason I think they slumped, maybe not the only one, is that when Ben Bernanke saw that QE2 had failed, he threatened to keep short-term rates at zero indefinitely. Okay, so that really disorganizes the long-term bond market, if I may say. So eventually you get into a situation where long rates approach zero as well, which is the one we're in. But I'd like to bring up a bigger topic. So Anne talked very well about global imbalances in current account and trade surpluses, that sort of thing. Now we've had these since the 1980s, but I'd like to talk about a new global imbalance, and that is tremendous differences in interest rates across countries. So we have the Fed setting interest rates at zero. That unleashes a terrific flood of hot money into India, into China, and to Brazil. It's, in the last 2 or 3 months, it's ebbed a bit with the euro crisis. But from 2001 to July 2011, there was a huge flow. And each of these countries could not control their monetary base. They had to sterilize with greater or lesser effectiveness. And this is one circumstance where floating the exchange rate doesn't insulate you at all. So countries that had floating or putting better flexible exchange rates, once they get hot money coming in, their currency starts to appreciate, and that gives carry traders a double benefit. They see the high interest differential, and they see the appreciation in the target currencies. So we get these swings, which are much greater in the case of flexible exchange rates than if exchange rates were safely fixed. So I'll just finish by saying the next G20 agreement, just forget about exchange rates for a while. Just think about interest rates and put pressure on, particularly the US, to get its interest rate up to a normal level, like say 2% for the federal funds rate.
Chandan, sorry, you've been waiting for some time.
Question to the panel, and you may consider this not really relevant or germane to this discussion. But I was wondering that, you see, given the size of India's black economy, the huge amount of resources that actually go in there and flow back often into the legit economy, plus the fund flows that come into Indian companies through the Mauritius route and other tax havens. Now, other kind of policy prescriptions that are being talked about, are they, do they really apply to all situations in India. You're talking about the legit part of the economy, but the black economy is at least 1/3, if not more, of the total volume of the Indian economy. So in that situation, shouldn't that be factored in whenever we talk of monetary policy and other kind of policy initiatives of the government? Governments do tend to ignore this. But I'm wondering, I'm just thinking aloud, as to whether there's any way in which this can be factored into policy prescriptions.
I mean, I'll take a stab at that. I mean, what you're talking about is a flow which is less under the control of the supervisory authorities. It goes through back channels, Hawala transactions, Benami transactions, et cetera, et cetera. And I think that is why you might argue that the supervisory tool may not be that effective in some situations. And the interest rate tool then becomes more effective because, no matter where you are, whether it's black money or white money, you do care about the interest rate because that's the effective rate you'll be charged in your SCID transaction also, or some. So it may be that what you're arguing for is that these effects are probably more pronounced when you have a country with a lot of black money, and so you want a more general tool rather than say that you can control it more directly through supervision.
And
Oh, just on Ron's point, the countries that are complaining about appreciating exchange rates are also the countries that had fiscal deficits when they should indeed have been running surpluses because of structural balance at the point in the cycle they were already overheating. And the capital inflows were a result of that. And the appropriate policy response was, of course, to tighten fiscal and loosen monetary policy, which worked in the correct direction. And the country that's complaining most, Brazil, is arguably the most egregious offender in that regard.
Anup, you want to say?
Let me just make two very different points. One is, what should a central bank do? I think it's very important what has happened the last 20 years, that central banks in most parts of the world have become quite independent and they're not political. So we've got to recognize they need to have a mandate and they must be independent to carry it out, and they cannot change their mandate because they're not achieving certain political objectives. I think it is price stability, financial stability. It has to be independent and non-political. It's very, very important. But the point I want to make, and coming back to your global imbalances, I think is quite interesting. A big issue has been China. And the issue has been that they may or may not make promises in their G20 maps, but the current account surpluses remain very large. They're accumulating trillions of dollars in reserves and they're not bringing it down. And clearly, I know my colleagues in the IMF, as part of the whole G20 process, have been saying that China's current account surplus is going back up, probably going back up to 8 or 9% of GDP from where it's been. And we have also said that this year, their current account surplus is going to be really going back up. Now, what is interesting is recent data tells us, at least for this year, and they carry forward effect for next year, that I think we've been wrong. I think we're seeing that the current account surplus is staying down. It's probably going to remain close to 5% of GDP for this year and much less than what we projected for next year. Now, you may argue there are two issues here. One is, what is the external rebalancing? Is it bringing in the current account? The second is internal. Is it being done for the right reason? What I think we're seeing is that the current account surplus of China is coming down. It is probably going to stay much lower than we had feared or thought the next year or two, but it's happening not because, as far as we know, it's not happening because China is shifting to consumption. It's also not happening only because of exports are weaker. It's mainly because imports are much more, and that's a link to their investment needs, and the investment rate remains very high. So the point is, they are rebalancing from an external point of view, but maybe it's not for the good reasons.
I have a question on this for three of you, actually. Basically, on the efficacy of the exchange rate on external balance and adjustment, in the sense that with the huge exchange rate adjustment of Japan, in the late 1980s, it didn't have that much effect on their surplus, the external surpluses, but it had a huge effect on the economy.
Offset prices.
And prices, right? And so the question in some sense is that on the issue of external imbalances, both whether it's deficit or a surplus, is it not the case that is domestic policies, which is to do with either there is excessive sort of fiscal expansion like in the United States, plus other policies reducing interest rates, therefore much higher consumption. Similarly, on the other side in China, there are various domestic policies which effectively curb consumption. Is that not much more important than the exchange rate instrument? This is a pretty broad question for all three of you. Yeah, sure. Arvind.
I think the key question is whether it's in some sense of that word market related, or where they are independent private decision makers, or it's the government. Whether you look at the oil, the oil trade or oil supplies are now, if I remember correctly, 80 to 90% controlled by state oil companies. In China, the investment, I would say, my guess would be definitely more than 70%, but maybe up to 90% is really controlled by the party, I call it. Government is just an instrument of the party. So it's different. I mean, you cannot apply to these two types of situations the normal things you would say would happen in a market economy, exchange rate, because there's a whole structure behind it. You're right that it has something to do with domestic, but that's also part of that control in a way of the system. So, but that doesn't take away from the fact that there is a policy structure which is producing these surpluses and creating the imbalance. So I would be more in with what Anne said
but Anne never said
than what Ron and others are saying.
Anne never said it was all the exchange rate. Be careful now, because what I said is that the U.S. was consuming more and the Chinese less than they should. China's savings rate is about 60% of GDP, and that is clearly high, almost by any standards. It's hard to believe that the Chinese people in their own welfare would not consume more if they had social safety nets, if they had the health coverage and so on, that might be expected. Now, it's also true that if the exchange rate were altered a little more, it might speed up the process. So I don't see it as either or, but I certainly agree that unless something happens on the saving investment, public sector, private sector combined balance, there's not much that's going to happen on the external balance.
Right, but one of the interesting things which Eastwood produced is that now the household saving rates of India is higher than that of China. So, it's very easy to say that it's something with the household. It's not. Actually, it's the corporate, which is really a public sector.
I didn't say it was household. It's
no, I'm not saying you.
No. It is largely the state-owned enterprises. We know that.
Exactly. No, I'm not criticizing. I'm on the same side.
Okay.
I'm criticizing the other, not you.
Raghu, defend yourself.
The corporate is really owned by the party, much of it. I mean, there's small, tiny things which they don't control, but that's small in my view.
I think the emerging consensus on China is what you stated, that the savings rates are high, partly because of the corporate savings. But the real issue, put it differently, I mean, we're all talking about the same macro variables. The income that households get are too low.
Yeah.
And therefore, the whole issue is how do you bring up those incomes? And clearly the Chinese authorities are trying to do that through a variety of means, including allowing wages to go up more, paying higher interest rates on deposits and so on. It's a slow process. And it's a process that, who knows what aging will do to it. But that's so China has two big adjustments that have yet to come, right? One is reacting to the aging, which is going to happen much faster in China than in other countries. Yeah. And the second is moving away from the fixed asset investment, which is getting more and more inefficient, to more consumption. And I think they're fully aware of it. It's first, when you have the leadership transition coming, it's very hard to move away from your path. Your chosen path easily. And second, I think once the leadership transition happens, we'll have to see what pace they start moving to this new structure.
Nick?
Just on China, the conference in March in Beijing, Lai Chang-en, who's chairman of the economics department at Tsinghua, presented a paper on rebalancing Chinese savings, and he made exactly some of these points. The fact that corporate savings have gone up, he suggested, is not a bad thing. I mean, given that in the mid-90s, something like 5% of GDP was used to subsidise the corporate sector between direct budget transfer and credit allocation, massively inefficient, but of course much of it was the welfare system. It was to pay wages and pensions. It's very desirable, in fact, that the corporate savings rate has gone up. The issue, and the fund and bank, I think, together have done a very good job with this, is to say, given that they've now got this massive profit holding, should the corporates be allowed to simply spend it in any which way they think is reasonable? And how they spend it, of course, is more investment, much of it, I believe, quite inefficient. But the proposal that dividends should be paid to the government, which can then consume on behalf of the Chinese people, to me makes very good sense. But by Chong-En's point in this regard is it's not going to change quite as quickly as you thought. It'll be fast because gradual doesn't mean slow in China, but it is going to take some time. He made another very interesting point as well, which is to say that rural people in China consume 100% of their income. But there has been a massive transfer from the rural workforce to an urban workforce, and those people save. So he said you're seeing, even though, as you say, Arvind, there's not much difference between Chinese and Indian households when it comes to savings rates, but even though Chinese incomes are rising quite quickly, there is a lag as people adjust to the fact that they now have higher incomes, and many are saving. I mean, someone's saving for houses, some are saving for to buy a car or white goods, or even perhaps pay for their kids' education, because a lot of the migrant workers in particular don't get the benefits. But we could see a quite rapid change in the Chinese situation as people adjust to this higher income. And I mean, the government has made quite clear in the way it's treated the labour unions in the past 18 months that it's quite well disposed to see increases in wages, and the cost structure for Chinese companies has changed remarkably, particularly the export-oriented companies that have seen the exchange rate appreciate, perhaps not as fast as some people would wish, but it still has appreciated quite a deal. And then the labour costs have risen very substantially.
Thank you, Nick. I have another question for all three of you. This is sort of connected with this Chinese wages going up, if that is true, as Nick is saying. That to the extent, Raghu, that we said, one thing you mentioned, that in the great moderation, the low inflation we had in the 1990s was partly driven by Chinese export of manufactured goods with the low prices. Now, if it is the case that now wages are going up, and so Chinese manufacturing good prices will go up, and this is also very relevant for India, so this inflation issue in India, is it the case we're therefore looking at some kind of secular increase in inflation sort of beyond the current recession in the world? I think all views are.
So, I mean, when you pose this question to monetary economists, and I don't pretend to be one, they will say the Chinese effect is one of relative prices, and the central bank basically can still determine the price level by being a little more aggressive. But I think the point that you're raising is a very, very important and valid one. That is, it makes fighting inflation easier when relative prices are going in the right direction, that the adjustment that you have to make is lower. And so you have, in one sense, a headwind to inflation. Inflation is being kept down by the China price, so that whatever action you need to take to adjust your price level becomes somewhat easier. That's one. Second, I think this is what we showed at the fund, is it could also work through wage competition. That somehow the option of shifting to China, where wages are lower, does put a lid on wage growth in the United States or elsewhere, and therefore keeps any second round effects of inflation much easier to contain. So if you put that together, what it says is, It may not change the basic role that you have as central bank, but it makes it much harder. And therefore, the kinds of, for example, interest rates you have to put in place to keep inflation under control, if there's an inflation surge, might be higher. And I think that's precisely the problem we're going to face. And eventually, I think once the industrial countries come out of this situation, it's going to be harder.
But I mean, higher global inflation could also solve the industrial countries' debt problem. In the medium term.
If it happens, people have argued that, and I'm a little skeptical about, it depends, right? For instance, government debt. Is it going to solve the government debt problem? It depends on the maturity of government debt. In many countries, the UK is pretty long maturity. So it's not surprising UK inflation is somewhat high now. But the US, 4.5 years. So it's not clear you get a lot of bang unless you have a sudden surge of inflation. And sudden surges of inflation are hard to generate. It's hard to do that very easily. The other thing, of course, is on private household debt, whether it will bring that down. The problem is it's not going to do anything for the debt based on floating interest rates. It can help for long-term fixed rate debt. There is some mortgages which are like that, but it's very important for that to be helpful.
In the US, I think 80% of mortgages are on fixed rates. Right?
I would say it came down during the thing. But the problem there for the US is, take the houses that are most under pressure. These are houses where people have jobs that are typically unlikely to have wages increase that fast with inflation.
So they'll be in worse trouble.
They'll be, well, potentially in worse trouble because all the other goods will increase in price. They can't get higher wages, and their mortgage doesn't change because they have to pay that fixed rate. So I think, it's easy to say inflation is the answer, but you have to think through. It may be, but you have to think through the process. I'm not sure once you think through it, it's that easy.
And any thoughts? Anu?
Well, I guess I'm a little bit more prone to think there will be inflation, not necessarily what it will do. But on the one hand, we've had, of course, all the quantitative easing and all that in the U.S., and if we're lucky enough so that economic activity picks up, then it seems to me that that's a real risk. And in a sense, we have obviously the excess or the rising demand from China and India and other places, and I can well imagine that we end up in a world where the pressures are inflationary. Certainly, I don't think that's the next year or two. I think it's a little bit longer term than that, and it certainly assumes that not only do the Europeans somehow manage to successfully resolve their difficulties and that we therefore get back on some kind of a healthier growth path and that there be no more unpleasant surprises, and I'm not so sure that those are necessarily good assumptions.
Just one comment. I think most people do believe that we are moving to accept high inflation for all these reasons. But the one thing I will say, coming back to China, China's had inflation well beyond 4 to 5 for some time now. It's been over 6. And from every perspective I have, Nick, my sense is that China, at least currently, the authorities are not prepared to accept a higher threshold for inflation. They want it to come back to their 4 to 5 range, and they're not prepared for it to stay even at 6. And the issue is why, and we don't know the answer, but people who want to give an answer say it's because they are now even more concerned of inequalities than they are of a so-called soft landing. And they're not prepared to accept higher inflation in China than what has been their range.
Thank you.
Yeah, so since this is international financial market, in the title, and also this IMF panel. So my question is a little bit sidetrack. What's the likelihood that IMF would be able to issue bonds to save euro?
Mr. IMF, Mr. Current IMF. Anne, would you like to take a shot?
Well, it's not clear the IMF can or should issue bonds to save Europe. And it's not clear that even if it did, it would save Europe. So that, I mean, there is a problem in Europe, and the problem is basically that there are some countries where basically they're fiscally insolvent, and there's some others that are running large surpluses, and neither side at the moment seems to be willing to make a sufficient adjustment. And that's the problem. And issuing, I do not understand how issuing more debt can solve a debt problem. There are some ways you can change maturities and stuff so that you can ease it over a bit, but in the European case right now, that's not the issue. So I don't think that IMF bond issuance has very much to do with it. I have not really thought through ECB bond issuance. Obviously, they could issue them. What that does to the price level in Europe as a whole is a different issue. And if they issue them, there are some other interesting questions distributionally. There are questions as to who's responsible for how much of the guarantee. There are issues that the ECB doesn't on lots of other things too. So, I mean, the bonds, I think maybe somebody's idea of how you put something together, but it's not clear to me that it goes toward the central issue. Raghu, you may have different thoughts on this, or Anup?
Well, I'll take away the easy way out. I would say that more, from my own personal view, the most important issue for many countries in Europe is to get markets and to get their own population to accept that they have a growth outlook which is positive. If it's not, this whole debt problem is very complicated.
Arvind?
Yeah, I agree with Anne that I agree with Anne that the current situation is unrelated to the issue of of the bond being. There's no chance of it for this particular purpose. But I have a paper which is on my website, which is on governance and quota reforms. And what I argue is that instead of always going, that IMF is supposed to be an equity-based institution, and so instead of going in general, this would be over the medium-term reform, in going for these special bilateral loans, etc. It should get the mandate to issue bonds and to be used in a macroprudential sense so that the debt equity ratio would fall in terms of a global boom and rise when there is a depression. And that's something to be considered for the medium term, definitely not right now.
Any other? Yes.
Yeah, I wanted to ask you guys really quick, to what extent do you think emerging market central banks should use their exchange rate as a policy tool?
So just say that again louder.
I said, to what extent do you think foreign central banks or emerging market central banks in particular should use their exchange rate as a policy tool, to steer aggregate demand?
Not at all.
Not at all.
Raghu?
Yeah, I agree with Anne. I think you don't want to use it.
But like in China, a lot of people have advocated that, if they let the RMB appreciate, maybe that would take some of the pressure off the inflation. Do you think there's any validity to that? Or?
I don't think that was using it as a, you're sort of letting it respond to aggregate demand. That to my mind is different from using it.
Good point, yeah, just stop manipulating it, I guess.
Yeah. Raghu, another thing that you mentioned in your presentation of the unified responsibility in central banks, particularly financial stability. Are you then arguing against the Financial Stability Oversight Council in the US?
No. Look, I'm not saying put the central bank in charge of everything. I'm saying that the central bank is probably in the best place to do banking supervision, especially when there's a choice between using the monetary tool or the supervisory tool. The trade-offs are best determined by the central bank. But if you've got a supervisory authority that can talk very well with the central bank and there are no turf issues, that's fine. But you know how hard that is. But that doesn't mean the central bank knows how to regulate stock markets and that it should be put in place. So I think the Oversight Council is about bringing everybody together. Now, I want to correct two things, actually. One is, I think I sort of am laudatory about the RBI and what it did on, what it has done recently on monetary policy. I'm less sure that that the RBI's slow stance in developing some markets is necessarily the right pace. Now, we will never know. But I on some markets, I think certainly the corporate bond market, more movement would have been a good thing. And I'm not arguing that the RBI stood in the way, but I think some more pressure from the RBI to move it. One of the questions I would put to Anup is, I have to believe that the fact that India doesn't have a good system for putting sick companies out of their misery has to play a role in the fact that we don't have a strong corporate bond market, right?
No, in fact, that's very important, Raghu, that when we did the financial sector assessment 3 years ago, 4 years ago, the one area in which we ranked just about last in the world is the bankruptcy code. And in fact, I was discussing this with Mr. Khurshid earlier this morning, that in the financial sector, the biggest reform, to my mind, which will affect a lot of these things, actually, the credit market, the bond market, is indeed the bankruptcy reform, actually. So I fully agree with you there, actually. No, the direction of a question on the Oversight Council, really, obviously, I don't think a central bank should be regulating the stock market, et cetera, insurance for that matter. The question, in a sense, is that when you shoot up the financial stability responsibility to an oversight council, which is headed by a finance minister or treasury secretary, whatever the system may be in a country, to my mind, it does two things. One, it shoots up the problem to the political level and politicizes the issue. Therefore, it actually becomes more difficult to take actions for financial stability. Two, it lets every regulator off the hook, because it says the responsibility is over there, not with me. So that's the sort of direction.
I would argue that it depends on how that's used. If it's used purely as a coordinating device, but not where you hive off responsibility to the council, I think that would be better. I do think there are places where, the council taking responsibility for systemically important institutions, at least partial responsibility, may be necessary. And, to this, just imagine what happened with MF Global. And I think we need to look at this because, with all the paranoia about financial institutions, how could MF Global, where they did the most basic thing of commingling customer accounts with their accounts? We've talked about financial regulation till the cows come home, but if you can find new ways to go bust every time.
But this is an old way.
No, this is the latest way. Okay, where you take. This is basic regulation. We're not getting basic regulation. That leads to another point. When you look at the details, at least the details will come out, the sordid details. But we are putting a lot of faith in the regulators being able to stand up to the political establishment. And what you see with MF Global is there was a lot of pressure on the regulators to go easy and to not ask the right questions. And I think we haven't solved that problem. That regulatory backbone is countercyclical. Regulators have a lot of backbone in a downturn, but as soon as you move away, the pressure makes the backbone sort of a little more flexible and makes it harder to stand up. So how do we get, with all the regulation we have in place, we still haven't addressed the question of will those regulations be enforced at the right time? And the right time is not at the bottom, but is as things start booming and you're asked to enforce.
Well, people have even raised questions as to whether when you have people in the private financial sector earning multiples of what people in the public sector are earning, whether the regulators anyway will be of a competence sufficient to match that of the very large number of clever people in the private sector who could think of all the detours around it.
Probably a random question. Going back to India, so what's not happening regarding capital count convertibility?
Capital account.
I don't know. I have an idiosyncratic view on this. Maybe Rakesh will.
I think when you first give idiosyncratic view. And then
I think that for most transactions, India is pretty much there. So it's not clear to me that what would people want to see. Now you can't take out a huge amount of money if you want to. So a rich investor in India, a rich family, can't take out 200 million overnight to invest in, to diversify their assets. But if they want to buy a company, they can do that, and they can take out pretty much large sums of money with the appropriate permission. So outflows are fairly open. Inflows, there's some regulation in limits on government bond markets, though those have been sort of loosened over time. Regulation on corporate bond markets, there's not much, as Anup said, to invest in. Infrastructure is being opened up. So it's not clear to me where more opening is sort of, I'm sure there are places that there can be opening, but it's not clear to me where the sort of major hurdles still are.
Yeah. Yeah, just to repeat what Raghu said, that basically the restrictions are on individuals sending money out beyond some limits, like, is it now what, $200,000 or it's still $200,000 per year per person. So if you're a family of 5, they can actually send out $1 million, but you have to have the money, that's the only problem, to send it out. The companies, there's basically no effective restriction, that companies can buy other companies abroad, invest abroad, etc. There is some permission involved, but it's not particularly difficult. Yeah, those are, again, financial stability issues.
Presumably any individual could start a company and invest overseas.
Yes, I presume. That's one. And the other one, as Raghu was mentioning, there have been limits on external debt. So you have some control over external commercial borrowing, you have control over the corporate bond market, and control over the sovereign bond market. And I think that I would mention there that there are almost all studies that have looked at capital flows, including the ones in IMF, almost all show that the difficulty in capital flows arises with debt. And that's where you have to be careful. That's what India has been following. And of course, there's been this sort of graded opening. And the question then is how graded the opening should be, whether it should be much faster, whether it should be slower, either way, actually.
My only comment on that is we're seeing in India the corporate sector investing overseas a lot. And I think this is catching up with what China is doing. So I think in some important ways this is taking place, and it's been an important change in the last few years.
And in that, some of the worry as far as the corporates investing abroad that has been there is corporates contracting external debt abroad for making acquisitions abroad, even though they're supposed to be non-recourse to the parent company in India. But in effect, if there's a problem, it's never non-recourse.
Of course.
Even though legally it may be non-recourse. And that sort of has been the only worry that there's been on Indian companies investing abroad with external debt.
I would, in fact, take the issue in a different way. I would say that in the last year or so, am I right, that capital flows to India have gone down beyond other countries. The real issue is not that we are too open. The issue is investment is not coming in India the last 1 year, as it has to many other countries in Asia. That's the issue, and we need to assess why that's the case.
Well, one of the things that has happened actually is also an interesting issue, that there has been, foreign equity flows have come down, and as debt has been opened more, with clear arbitrage, debt flows have increased, which is exactly the wrong way to go.
Wrong way to go, that's the whole point.
And there's a financial market question in terms of external investors, that is it the case that that in terms of portfolio investors, that international funds of different kinds have some country notional or clear limits, and therefore if you loosen the debt, you reduce equity. It's not that you just add to the equity. That's a question, I don't know the answer to that, but I have a suspicion that it is, because I think you're seeing that as you open the debt market more, you reduce the equity flows and you increase the debt flows because they're safer and you clear arbitrage going on. Any final round of comments?
Maybe I'll make one final comment on, as not a final comment. From what I've heard, there's so much concern now about all these, how you balance growth and inflation, inequalities, financial stability. And to me, nothing is more important personally. You've got to have one institution, the central bank, that's independent and does what it needs to do, and that forces the government to act. We saw this in Latin America the last 20 years. As you move to more independent central banks, the social need for low inflation rose. This forced governments to act. You have to keep the independence of central banks.
Any final comments, Raghu?
So.
Well, thank you very much indeed.